And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Well, we're entering July 4th, and that's going to be fun. And, you know, when you look back on July 4th, and it's not the, grilling of hot dogs and hamburgers and the beach and all that. It's amazing how, when you look at it, one man, Washington, when he crossed that Delaware that night, if he didn't win that battle, he went against these German mercenaries. He knew if he didn't win that battle, the whole revolution would go down the tubes and we'd be part of Europe. And when you think of July 4th, you really got to think about that, how we got our independence. These guys that crossed the Delaware that night, did you know that a quarter of the men didn't have boots or shoes? They were walking in that freezing cold in the snow with just heavy woolen socks on their feet. And they had to beat those German mercenaries. And Washington did that. And when you think of what these men did to get our independence, it's amazing, isn't it? So it's not about hot dogs and hamburgers. It's about thinking about these men and the guys who wrote our fathers who wrote the Constitution. Just genius. And these were people who put everything on the line. These were very wealthy people back then. They came from Europe, very wealthy, and they could be killed. They could lose everything. So everyone should, at least I think about that. And I think that one battle, if Washington didn't win that one battle, everything that we have today wouldn't be here. And now they're trying to take it away from us again, right? With these commies who are just winning these elections. But this is not a political show, so I don't really want to get into that. But it has a lot to do with what we do every day, trading, because it's always about policies. And you got to have courage to stick with your policies. And I think the president is doing a great job. But I don't understand, the one thing I don't understand is why he has to exaggerate. For example, the other day I'm listening to, here, why don't you play the clip?
The average 401k is up almost $30,000 since I took office.
That's just not true. His staff didn't give him the right numbers. That's all nonsense. That's not true at all. The numbers is about $9,000. The average 401k is about $9,000, not up $30,000, up $9,400. That's about 7% gain in your 401k, not 21%. No age group saw anything close to $30,000. So I don't know who gave him those numbers, but that's pretty bad. So, and when he said that at the Roosevelt opening of his library, I just said, I just don't get it. I mean, why would you make a statement like that? People are going to find out. So, and people are going to find out too that we have the stock market. You talk about fireworks in July 4th. My God, we're going to have some big fireworks soon. when it's finally this market will correct itself, it will crash. There's no question about it, because this is the narrowest leadership that we've had in a market. There's just the structure's crazy. And we never had such narrow leadership. Even in 2000, even in 1972, 2018, the leadership groups were bigger than today. So in 1972, it was about, say, 15 stocks. In 2000, it was about 20 to 25 stocks. The FANG era, it was about 5 to 7 stocks. Today, it's just 12 stocks. So think up, there's 5,000 stocks, but there's 700 stocks that are the stocks that trade every day. And it's the narrowest leadership in modern market history that's leading these 700 stocks. Now, you go back and look, 1972 to 1974, the Nifty 50 era, as I said, had 10 to 15 stocks. You go back in 1999 to 2000, the dot-com peak, there's about 22 stocks. Remember, Cisco, Intel, Microsoft, Dell, they're still all around. 2018 to 2021, the FANG plus the mega cap tech, about 5 to 7 stocks. So 700 stocks, think about that, out of 5,000 that trade every day. And the S&P 500, the NASDAQ 100, and the XLK, that amounts to about that 700 stocks. And there's 12 are holding up to 700. And we know what stocks those are. Those, of course, are your chip machine makers, the 4 best stocks in the market that everybody's in. And then you have the companies that buy the chip machines that are made by these 4 companies. So you have 12 companies. That's it. That's so dangerous. And the one thing that all crashes, all these past crashes that we've had, and take the last 5 crashes in the last 25 years, they all have the same thing in common. It's the leadership that collapses. And that is the first thing that happens. And that's just every stock, every crash we've had, going back to the tulip market, it always ends up with the leadership collapsing. The Nifty 50, the dot-com, the FANG, the mega caps are in, and today, the AI chip machine makers, and so forth. So out of the 700 stocks that the institutions actually trade off of, and by the way, the institutions aren't participating anymore. They pulled out of the market because they don't like the yields. They're too volatile. They're just way too volatile. And so they parked their money into the 4 biggest companies. Those are the big machine, we call them factories. They make the chip machines. They parked most of their money there, and they pulled out of the market. And that's a very bad thing, because what happens, and will cause a crash eventually, is you don't have institutional money managing the market. You have computers, machines. And the bad thing about that, and I talked about this the other day, if you have a big rally and you're jumping in, most people jump in at the top, called FOMO, fear of missing out. You're going to get crushed if the machines are operating the market. Because when they rally a market, they have buy orders. And the way the machines or the computers are set up, when those buy orders are done, they turn around and start selling. As I said the other day, when you have the institutional money They don't do that. They hold that position. So if your stock up 2, 3, 4, 5 days, and you're up about 12, 15%, you know you can hold on to those gains. But if the computers are taking over the market, which they are now and have been, because the institutions aren't participating because they don't like the yields and how volatile they are. So that's a pretty, that's a real tough thing. So again, I don't want to get off my point. So going back to these 700 stocks, go back to these 12 stocks, and again, just to finish that thought I had a moment ago, it's just, think how dangerous that is. You rally a market, and you think you're safe, and all of a sudden the computer immediately starts doing sell orders. That's why you got to put stops in, and you got to take profits, and you got to watch the yields, because the yields always tell you the direction of the market. The one good thing about the bond market, the yields will always tell you the direction. You'll always know in advance if we're going to have a correction or crash if you know how to read the bond market, the yields. And it's very easy. Anybody could do it. Even if you don't have a high school education, you can do it. And that's me. So we got the chip machine. Think about this. We got the chip machine makers, okay, AMAT, ASML, LRCX, and CLAC holding up, really, they're the ones that are holding up this whole stock market, 4 companies. Now, underneath that, holding them up, are NVIDIA, AMD, Broadcom, Intel, Micron, 12 stocks, Google, Meta. That's the whole market right there. That's it. So you got 12 stocks, the machine makers, and the people who buy the machines they make. That's it. That's the whole stock market. 5,000 stocks, that's it. You pull those out, you don't have a stock market anymore. So now this has happened, and you think we would learn. You think Wall Street would learn. You think the Federal Reserve would learn. But the Federal Reserve never does anything right. They got a bunch of educators. You want to see the people on the Federal Reserve Board. They never built a business, don't understand business. Most of them are, they're professors. But we've had this happen 3 times before. The dot-coms, 1999, 2000. And remember, we had a tiny group of mega caps back then. Remember them? Cisco, Intel, Microsoft, Dell, Oracle, Sun. That carried the whole market back then. And what was the outcome? A crash. The S&P went down 49% and 78% in the NASDAQ. That leadership cracked. The Nifty 50, 72 to 74. Same thing. Handful of stocks. Xerox, Polaroid, Kodak, Disney. They were the leadership back then. Same thing happened. The leadership cracks first, taking down the whole market, wiping everybody out. Same thing. Market breadth collapses. Everything happens exactly the same. The outcomes are always the same. That market dropped about 49%. Then we had the FANG concentration, 2018, 2021, a handful of stocks again. Apple, Amazon, Microsoft, Google, Meta, and Netflix. They carried the entire market. What was the outcome? The leadership cracked again. What the hell is it with the Federal Reserve that they don't see that? 2022, that leadership cracked. The S&P dropped 27% and the NASDAQ 33%. Are these people that stupid? These educators who are on these boards, these professors? Why don't they pick somebody sitting on that board? Doesn't have to have a college degree. Have somebody who runs a plumbing company or an air conditioning company. Or how about somebody that runs as a contractor? Let them sit on the board. They would do a better job. They know the real world. These morons they put on these boards on the Fed. Look, most of them never had a job. They've been in college their whole life. Now what caused these markets to reach that same danger point? That's what gets me. Every time we reach that same point, you can see it coming. It's happened before. But they don't do anything about it. You have the Fed tightening liquidity too far. Now, I'm going to take a little time and finish this up because I don't want to leave you hanging with this, because this is important. Just like the job numbers. Do you know these job numbers today were totally BS? Do you know these job numbers everybody's all excited about? There's not a good job in there. You know how many full-time jobs? That 54,000, I think it was 54,000. You know how many full-time jobs they produced? Zero. You know what they didn't tell you today? 500,000 full-time jobs were lost. So we got 54,000 of crappy jobs that don't pay anything. And by the way, most all of them are part-time jobs. This is insane. So they're celebrating 54,000 jobs today, which are crap, are useless jobs. They're part-time, and they're all terrible service jobs. Clean hotel rooms, stuff like that. Dishwashers, all lousy paying jobs. But they're celebrating like we had 54,000 jobs that are paying, somebody $1,500 a week with all kinds of benefits. That's what they're celebrating. Like you think that was what's happening. There's no benefits in these jobs. There's nothing. But let's get back to the market. There are three things that has killed all these crashes, that created all these crashes, and they do it over and over and over. The Fed tightens liquidity too far. That means the rates are too high, the yields are too high. And then a lot of times they do QT at the same time. Also, that combination, remember, kills the breadth, forces institutions into a tiny group of stocks, and creates the exact setup that we have today that preceded every one of those crashes. Isn't anyone going to stand up and sit on the board and say, look, here are the 5 last crashes we've had. And let's identify what happened. How did we get to this point that each one of those had a crash? And when you look through it, put it up on a whiteboard. Just write it down. What was the same thing that happened on each one of them? What caused each of the last 5 crashes? Everything is exactly the same. Nobody's looking out for that? No. Because that's how Wall Street makes money. By creating markets that will rally where they get very, very wealthy, and then they pull the plug and they let the market come right back down where they get wealthy, shorting the market. But who do they protect on the way down? Who doesn't get hurt? Who got out of the market? All the big institutional money. They don't ever get hurt. If you look at where all that money, whose money? Well, you're talking about corporate pensions like Ford, GM, UPS, IBM. They never got hurt in any crash. Also, look at all the wealth funds, the teachers' unions, 401ks, IRAs. They're all managed by gangsters like J.P. Morgan, Goldman Sachs. And this is what makes me laugh. People that trade, they have no idea. The small retail trader, they don't give a hoot about you. They don't make money on you. That's where they make money, on the big pensions. So you have about 12 companies, hedge funds, and you have Vanguard, Fidelity. You have a handful of companies that are managing $50 trillion. They make a fortune doing that. They don't care about you, the retail investor. They made sure they convinced you, took parking space in your head, that you would keep cost averaging down. When the market is collapsing, a stock is collapsing, and it's in a downtrend, and money is collapsing, what do they convince you to do? Cost average down. What's the worst thing they had you do? Buy on the dip. Enron, classic example. Nobody should have lost money in Enron. Everyone who lost money in Enron, you should have lost it. All you had to do is turn around and short the market. But no, what was everybody doing? Adding to their position as the stock was collapsing. Who told you to do that? Wall Street. Wall Street doesn't work for the small investor. No, he works for... Do you really think that J.P. Morgan, Goldman Sachs, Vanguard, you really think these people work for you? If you have 10,000, 20,000, 100,000, even if you have 1 million, they don't work for you. They don't get interested in working for you till you have at least 5 million. But I want to get back to, again, here we are. The same thing that happened with all these crashes is now happening right now. So all you just got to do is sit back, learn how to sell short. That's your insurance. You're going to lose your 401k, whether you're up 11%. You're not up, I don't want to disappoint you, you're not up 30%. That's a bunch of BS. You're not up 30%. Okay? I mean, you really dig into it, really dive into it. No way. No way. That number is so bad. So the market breadth right now is collapsing underneath us. The Federal Reserve keeps tightening the liquidity too far. And the Fed keeps the Fed fund rates too high for too long. And the bond market keeps pushing Treasury yields way too high. And here's why they are doing that and why you're going to have a crash. Because we spend $5 billion a day more than we take in. Our deficit is about $2 trillion a year. So we're losing about $5 billion a day. Every day they got to sell treasuries to cover that $5 billion a day. And they've been doing this for so long now, they keep, instead of cutting expenses and cutting back, they keep on printing treasuries, printing, and selling treasuries. Now they're selling the 2-year treasury. That's why you got to follow the 2-year treasury if you're trading stocks. You got to follow that 2-year treasury. It tells you exactly when the stock's going to go up and exactly when the stock's going to go down and when it's going to crash. So the bond market has to. So every time at the end of the day we got $5 billion, we're in the hole. They got to raise that money. They have to borrow that money, and they sell you treasuries. And the problem is, the more they keep selling treasuries every day, that pushes yields up. And that's why, if you take a look at your most popular stock, the 4 machine stocks, right, that makes the machine for the chips, they're getting hammered today. I told my members, my members have been with me a long time, that go ahead and do some swing trade shorts on those things. We knew they were coming down. Now the trend is still up overall, so we're not worried that this whole thing's just going to collapse. No, it can go right back up, obviously, because the trend, again, is still up. You don't follow what they tell you on TV. Follow the money, which is following trend. But anyways, they have to attract buyers. They have to keep selling these treasuries, and that's the problem why the market crashes. One of the many reasons why the market crashes, because the more they spend, the more they can't cover that spending, the more bonds they have to sell to raise money to cover it, then the yields keep going up, and the yields will kill you. The yields will kill you. And that's what's going on. So the Fed has done nothing. They've done nothing right, and they're not going to change their way because it's politics. They don't care about you. The Fed has no interest in you, the small. If you're making between, let's say, between 45 and 115,000 a year or 100 a quarter a year, you haven't got a chance because they do not care about you. They don't even know who you are. They could care less. They're not there to take care of you. They're there to take care of the teachers union. They're there to take all the Ford, GM, all those pensions. They're not there for you. But let's get back to the point. So the Fed has done nothing right. Nothing. So they tightened too aggressively, like they did in 2022, right? Instead of letting the supply chain normalize, they don't do that. They held rates too high for too long, 2023 to 2026. Even after inflation fell, these morons kept the rates high, tight. They inverted the yield curve. And 99.99% of traders don't even know what inverting the curve yield means. And they just keep trading along. Oh, Kramer, what stock did he say to buy? I better buy that stock. I better get in here quick. And you buy right at the top, of course. The yield curve, the further we get away from 150, okay, the further we get away from 150, the yield curve, the perfect place for the yield curve to be is at 150, okay? We're so far away from that 150, that's what causes crashes. So, they've inverted the yield curve for a record length of time. This breaks the bank's lending and credit creation. When you have a yield curve that's so far away from that perfect 150, the banks don't lend anymore. Credit creation's gone. They keep draining the money through QT while banks are already are too tight. They force the market into a stock leadership structure. So when liquidity or money dries up, institutions pile into the only stocks that can survive, and those are the mega caps. Now, so out of 700 stocks, they all jump in and hide in 11 stocks, 12 stocks. They did the same thing in 1972. The Nifty 50, when that crashed. Did the same thing in 2000. Same thing in 2018. FANG, remember that? 2022, they did the same thing. And the same thing today. You'd think they'd figure out, we're not going to, the things that caused the crash, 1972, 2000, 2018, 2022, they know what caused it. And the same thing is now, the setup that caused that is setting us up right now. Why wouldn't somebody stop that? Well, they're never going to help you, because they always make money when the market goes down or the market goes up. I don't care if your 401k went up 9,000 or 30,000. It makes no difference. 401k is a failed experiment because nobody ever gets out with that money. If you look and you got 300,000, you got 100,000, you got 85,000, you never ever retire with that money. Because the market will always take that away from you. It will always crash. Because why? Because the Federal Reserve knows what makes markets crash. And you say, well, why don't they just stop that? They know all five what happened, why would they? That's how they make money. See, they make money on moving markets up and moving markets down. They direct where the market's going. It's not a free market. They create the bubble on the way up. They decide to pop it. And then they start all over again, making another fortune. They pop it. Then it comes all the way down. See, they always have to pop it because the prices get too high in these stocks. And when the prices get too high, the average guy gets priced out of the market. Stocks we're trading today, $500, $600, 5 years ago, were $35, $50. So they let this happen. Then they'll pull the plug to get those prices back down again. And they make money on the way down because they short. And the 401k, nobody ever times the market perfect. I'm retiring today. Why, I have $1 million in my 401k. I'm retiring today. Why, I have 800,000 or I have 500,000. Let's say your goal is $500,000. I'm going to retire today. It never happens. It never happens. You always get wiped out, or a good portion of it. Now, the market is a simple place. It really is. It's these geniuses who screw it up, make it complicated on purpose. Because the only way Wall Street can make money, and all these financial TV shows on TV, when you see these jibber jabber comes on, I love these jibber jabbers come on. Here's Joe Suckface. He's managing $500 gazillion. What do I care? Who's he made money for lately? They're all in cahoots with each other. But it doesn't matter. You can turn the TV off. You can look at a chart, and as long as you're watching the bond yields, it will tell you when the market's going to crash. When the 3-year Treasury crosses below the 2-year, it's been never wrong. And when the 3-year crosses below the 2-year, not only has it never been wrong, but IWM will turn red, and that gives you the signal it's now a fact. It's solidified. It's going to crash. So you can just sit, if you know how the market works, you can avoid all this. You make money when the market goes up, you make money when the market goes down. But see, they kept the average trader out of that loop. They don't want you to make money on the way down. That's where they make money. They don't want you making it. Okay. So have a great holiday. All I'm saying is we're going to see fireworks like we never saw in a 4th of July ever at some point. But in the meantime, if you know how to sell short, that's your only safety net. How to sell short. And then when you know how to sell short, you can protect your 401k. You can't short it, but you can hedge it. And we'll help you with that. Well, thank you for listening. Have a great holiday. And remember, when you're eating that hamburger or that hot dog, the reason you can grill it and eat it is because 25% of the people who were crossing in those boats going across the Delaware to fight that battle with the German mercenaries, 25% only had socks on, woolen socks. Imagine in freezing weather. And that's why you can grill. And we have to celebrate that. See you on the charts.